Welcome back to another video. Today we got a market Sunday. Okay, so we're just going to be checking out what is going on in the market and what I'm planning on buying this week. You got to close that Ice JJ Fish tab right there. That is fire. Okay, so one thing I'm keeping my eyes on is the COVID counts. Okay, so as we saw Texas open back up. I believe it was on March 2nd. So that means that 14 days later we should start to see the spikes in cases. So I decided to go in there and take a look at it. It looks like cases are still trending down, whether that be as a result of interventions or the vaccine, or maybe we're just reaching herd immunity because a lot of people already got the virus, or whatever the reason is. It seems that cases are starting to trend down and the reopening is happening in many places. So that's something that I've got my eyes on. And without further ado, the story of the weekend has been, why is XRP surging? So XRP, for you guys out there that don't know, is basically a crypto. It was delisted from a lot of different exchanges, and it's been spiking, spiked about 39% after a United States court ruling. So what happened? Ripple saw another major win because it basically won a legal battle that is going to make sure that executives don't have to provide their personal financial records to the SEC. So it's going to be a little bit more deregulated. So basically they want to be treated as what their function that they actually serve, which is interbank communication. So I'm not going to lie, when I saw this, I thought about jumping in. It seemed a little bit exciting, the whole Ripple thing. The previous high, I believe, was 140 or so, and it surged through that. And we're seeing a really bullish move in XRP. So that's interesting, but I got to stay the course. All right, I'm focused on my retirement accounts. All right, let's pop over to Yardeni Research. This is a very good research platform. And what I want to show you guys today is what's going on in the stock markets and also what's going on in the US bond markets as far as bond yields and things of that nature. So then we're going to look at Progressive, and I'm going to show you guys a little what I would call a shotgun blast that I'm going to be doing of stocks. I'm going to be buying several partial shares of a stock, and then I'm going to be putting a little bit more of a chunk into Progressive. I just want to show you guys some numbers with that. So let's go into US stocks first. So we're going to go through all of this stuff. So sector indexes. So we see that the US stock market is still trending up. One thing that I wanted to highlight down here is that we are seeing a little bit of a rotation back into tech. So we see the highest performer of the week, month to date rather, is information technology. So that's what I was buying last month. So last month we saw a huge underperformance of IT, information technology, and this month it's kind of bouncing back here. So other good performers we're seeing is communication services. So things like Verizon, okay, like telecom, those are performing well. That's what I was trying to get into a couple of those. I did buy some Verizon very passively, but yeah, just some telecom plays. Information technology is doing well. Let's see what's the next biggest performer. S&P went up 3%, aided by IT technology. Underperformers is, I think energy was the worst performer, negative. Energy went negative. So like we said, you can't just keep on trading in one direction. Financials traded pretty well this week. The banks got a big boost from interest rate hikes, not hikes in the sense of the Fed, but they're starting to go back up. But that's something to pay attention to, is looking at what these charts are doing relative to each other, what's becoming more expensive, what is becoming less expensive. So we look at the forward PEs of the S&P 500, which is large caps, 400s, mid caps, and the S&P 600, which is the small caps. We see that the cheapest sector right now is the mid caps. So that's something interesting. Last time we talked about this, the small caps were the most undervalued, and now we've seen a little bit of rotation out of the mid caps. So that's an interesting thing to watch there. The VIX, we always see the VIX spike in these recessions. So this is back here. This is a recession. This is the .com crash. This is the 2008 crash. We saw a big spike in the VIX. We saw a huge spike in the VIX over here when we went into the pandemic, and we're seeing a downtrending VIX right now. So the VIX is getting to, down to these lows over here. So we're seeing some pretty smooth sailing in the stock market. So like we said before, nothing goes on forever. So we see the 10-year bond yield spiked up to 1.67, and we see that tips have gone negative. So I had to look this up myself. The answer is that the yield on a TIPS bond is equal to the Treasury bond yield minus the expected inflation rate. This is an essential characteristic of TIPS because they are designed that way. As long as Treasuries continue to offer yields below the expected inflation rate, TIPS will remain in negative territory. So moving on, the 10-year expected inflation rate. So the way that they calculate this is the nominal 10-year Treasury minus the 10-year TIPS yield. So that's basically going to give you this negative number. You're subtracting a negative, so you're adding it to that. So the expected inflation rate is 2.31%. That's what the market is expecting. So checking out the yield curve, we see that we continue to tick up as far as bond yields on the 10-year, and the Federal Reserve has pegged the funds rate all the way down basically to zero, okay? 0.16, 0.13, that's basically zero. All right, and we see that the 2-year is down at 0.16. That's basically matching the Fed funds rate. Down here, we got some foreign bonds. So a way to look at this is that the price is the inverse of the yield. So we're seeing that Japan is flat, so they're not really buying or selling the Japanese bonds off. Or you could just look at it as the price are so high already that there's already no yield. We're seeing that the German bonds are negative, and we're seeing that the US bonds are ticking up. So these are both ticking up, so we can essentially assume that that's a sell-off of bonds. So with the sell-off in bonds, that cash has to go somewhere, but as we see equity markets going up, that could indicate that people are taking their bond proceeds and they're putting it into the equity markets, right? And this would make sense to me just because, you want some type of protection against inflation if you're expecting more and more inflation. You don't want to be being paid a fixed amount when there's high inflation coming. Okay, high yield corporate bonds. So this is basically junk bonds. You see that they jump during recessions. So they're trending down and down and down. So essentially what we're seeing when we're seeing this trend down and down and down is the inverse of the price. So the price of junk bonds are going up, which means there's more demand, which means that people are being pushed further and further out the risk curve to find some yield on their investments. All right, we got municipal bonds over the past 20 years. Pretty much what I see when I see this is that the bond yields spike during recessions, and we generally see that they're trending down over time, right? So that as we've started to pump more and more money, we saw a spike here right after 2008, and they've just trended down and down and down over time. Things have become more inflated. Higher prices means lower yields. And once again, we see spikes in munis every time there's a recession. All right, and basically here we see the dollar index. So it's basically the inverse of inflation. So when we saw the deflation at the beginning of the pandemic, the dollar went up, and then we started to print that money. We started to get, some people would say the economy moving again, and the value of the dollar went back down. Now we see the value of the dollar ticking back up. So that's something to keep your eyes on there. All right, we see commodity prices are continuing to tick back up. Oil took a little break here. Oil has started to tick back down. Who knows where that's going to go, but we can't see a one-way trade in oil. But if inflation continues to take off, we're going to continue to see these commodity prices go up, and these oil prices will do a reversal and tick back up. Another interesting chart they've got in here is growth versus value. So if you have this underneath, you see that growth underperforms value. And if you have this line over this zero, you see that growth is outperforming value. So what we've seen basically since 2018 is that growth has been outperforming value. And generally there's been kind of a rotation into value, but it was starting to move towards this line, and then we ticked back up. Okay, so we were starting to move towards a growth outperforming value, and then we ticked back up. If we see another reversal, we might go to the point where we start to see value outperform growth. So if you're watching the rotation, then this is something interesting to look at to see at what point is value actually going to start outperforming growth. And there's a lot of factors that go into that, including the inflation rate. So that's something to keep your eyes on Yardeni research. I thought this was pretty interesting too. This is cap weighted versus equal weighted. So essentially cap weighted means based on the size of the company, and equal weighted means if you just took all 500 companies and equally put capital into them at the same amount. So we see recently that equal weighted has actually been outperforming, which is kind of a good indicator for my M1 finance strategy. I mean, I'm not really saying that that's necessarily how to outperform, but it seems like that is what's going on. Maybe that can indicate a rotation into smaller companies. Maybe if you had an equal weighted, you're capturing more of those returns of the S&P. I'm not sure exactly what to think of that, but that's just an interesting chart that the cap weighted index is actually underperforming the equally weighted index. Moving over here to the US bond yields, we're looking at the 10-year treasury. We've seen that it continued to tick down and down and down. We're still on this downward trajectory, but we have had a slight leg up here recently in March and April. This is a little zoomed in, so we're seeing it's not just the fact that bond yields are rising, it's kind of the rate at which they're rising, so that'll be something to keep your eyes on. US mortgage rates. So mortgage rates are ticking back into the threes because the mortgage rates are typically the 30-year. So I've been looking around at mortgage rates, and they're typically 3.1 is like the lowest you can find these days. So at the beginning of the pandemic, it was down into like 2. I locked in at 2.75 while the pandemic was raging at its height. But right now it's looking like about 3. So 3.19 is typically the mortgage rate. Credit dependent, of course, because if your credit is worse, it's going to be a higher rate. All right, yield spread between US high yield corporate less 10-year treasury bond. So this spread measures people's appetite for risk. So the wider the spread is, the more people are risk averse, right? So the higher this yield is relative to the treasury bond, that means that people are more willing to buy treasuries. People are less willing to buy junk bonds, essentially. So as this starts to trend down, we see that we're increasing our appetite for risk. So generally, same thing for these municipal bonds. We've got, as this starts to trend down, that means that we're getting less risk averse, right? We're moving further out the risk curve to find some yield, and right now it's only 1.18. That's your risk premium for going into munis right now. Very, very interesting. So it looks like the AAA municipal bond minus the 10-year treasury, if you take the 10-year treasury and subtract it away, you've got essentially negative 0.49. So essentially, if this is negative, that means that you're getting more yield on the 10-year treasury than on the municipal bond. So you're actually getting more yield, or in other words, you can equate that to risk. People think that it's more risky to give a loan to the government than a municipality that's AAA rated. So that's very interesting there. So this is an interesting chart. We see that after the lockdowns began, we saw a little spike. Then they went back down as we injected some liquidity into the system. But slowly and surely, these yields have been ticking back up as people start to expect more and more inflation. So that's it for the bonds and the stock market. I'm going to go into this progressive really quick and show you guys some progressive, then also show you guys what else I'm planning on buying. So check this out. So net premiums written. So essentially, this is basically revenue for an insurance company. So we see a 13% year-over-year increase in premiums written. So that's how much customers basically pay, but there's still obligations on those premiums. So premiums earned are essentially, these premiums were paid to the company, and they don't have any obligation on them anymore. So year over year, in February, they've got a 10% increase in what you could call earnings and a 13% increase in revenues. So they took a little loss on their securities. They took a realized loss, but let's go over into these other things. I just wanted to show you guys the definitions. Written premiums, essentially that's revenue. So you guys can take a screenshot of this. Earned premiums are essentially what an insurance company would consider earnings because they don't have any obligations against those premiums that have been paid out. One thing that's interesting that Warren Buffett really likes about these types of companies is that they have a float. So where's the float? I can't really find the float, but it's about 585 million. So what they can do is they can invest that float. From what I've found on the internet, they typically get about a 5.56% return on that float. So whatever they have with that float, there it is, 583 million. So they can grow that, they can invest that, they can use that for acquisitions. Putting $350 into my Roth IRA on Monday. 100 of it is going to go towards Progressive. I think that they are a beast of a company. I think that they are a great long-term play. They're going to be a good turnaround play in my opinion. The rest of the 250 is going towards these 6 stocks: AbbVie, Altria, General Mills, Pfizer, British American Tobacco, and AT&T. And essentially my rationale for buying into these stocks is that I'm focusing on the value portion of my portfolio. So if the tech part of my portfolio is running hot, I'm going to shift my focus over to the value and try to buy what is relatively cheaper, because I'm just trying to dollar cost average increase my cash flow, and increase my positions over time. So anyways, hopefully you guys liked the video. If you did, make sure you give it a thumbs up. Hit my links if you guys want to support the channel, and I will see you guys in the next video.